you're going to find a chart that is basically historic rents over time and what they've done. That chart is very eye-opening for a lot of people. Basically, that chart only goes in one direction. Over the 70 years that chart shows market rents, and this is nationwide, obviously, right. Real estate's location dependent. Across the US over the last 70 years, rents have never nominally gone down. 2008 to 2009, they flattened out for about a year and a half. Never gone down. So if your concern is that we're going to get into a recession and rents are going to go down, I'm not saying it can't happen, but it will be the first time in history that it has.
Welcome back to the Real Estate Syndicator Live, episode 23. And I am so pumped to have my good friend Jay Scott in the house today to talk about macroeconomics, where we are in the macro world, and how that, maybe more importantly, how does that affect multifamily, real estate, all that stuff. I'll let Jay do a little intro on him, although I'm not sure he needs too much of an introduction. But I wanted to show, literally, I showed Jay before this. So give me an idea. How many of you guys saw Jay's post? I try to share it today, but Jay just did an amazing post yesterday on Facebook. And it was like, 10,000 words or something. Did anybody see that? I'm going to put that something in the chat. Anybody read that? And while you're putting in the chat, I literally printed out this is a Facebook post. I printed out the Facebook post and it was 5 pages long. It's like a little mini ebook that he wrote, but he was basically doing a great analysis. And I wanted to start with walking that through before we get to your questions. So as a reminder, if you've got a question, just drop it in the chat because we want to make sure we're answering your questions and giving you guys the value. But before I get into this, Jay, buddy, you want to spend a minute or so, tell the folks who don't know who you are, who you are.
Yeah. So I am an engineer and business guy by education and spent my first career in the tech world. Started in real estate back in 2008. I flipped a lot of houses, wrote a couple of books on flipping houses. About 5 years ago, transitioned into multifamily. Basically found a friend of mine, Ashley Wilson, who had been doing multifamily for a while, and begged her to mentor me, agreed to basically volunteer my time to her business for a year if she would mentor me. She agreed to do so, and it ended up being an amazing partnership. And we're now partners in Bar Down Investments, and we syndicate large multifamily throughout the Southeast, mostly in Texas. We've been working with Bethany and Mauricio for many years before I joined. So that's how I know them. And so economics has always been kind of one of my hobbies. I wrote a book back in 2018 called Recession-Proof Real Estate Investing, which is basically an overview of economic cycles, how the economy works, and how we as real estate investors can leverage different parts of the economic cycle to reduce risk and make lots of money.
Yeah, and Christopher in the chat's already saying that you wrote a book on AVR costs for Bigger Pockets. He bought a bunch of those, but you're pretty involved in the Bigger Pockets community, right?
Yeah, I actually started when I started investing back in 2008. I did a Google search for how to flip houses and found my way to Bigger Pockets. It was a pretty young organization back then. There were, I think, a couple thousand of us. And became friends with the founder, Josh Dorkin. We remained friends. I wrote the first couple books that Bigger Pockets published. They're now, I think, the largest real estate investing publisher on the planet. And so I've been involved with that organization for about 15 years and a great group of people.
So you entitled this, "Are We Currently in a Recession?" And I wanted to go through some of those points that you were pointing out. You started with something super interesting, which said, does it really matter what the technical definition is, right? We've all been hearing about recessions being technically two consecutive quarters of negative GDP. And, the White House was mentioned something. And I know the National Bureau of Economics Research, you spent a lot of time talking about that they are kind of the official callers of recessions, but it takes them months or years to, they're in the business of looking back and making the call for history. They're not necessarily here to tell us whether we're in a recession or not. But you brought it up on a really interesting point, which is, almost like, who cares? Does it really matter whether we're technically in a recession or whatever the words are? The question really we should be looking at is, how is this affecting the people in the real estate world and, all the players in the economy? Are they suffering or not? Because at the end of the day, that's kind of really what matters. And you went through 4 or 5 you actually literally went 4 or 5 different topics. And I wanted to go through each of those before we get to the members' question, because I want, not everybody's read we call it a report. And everybody's read the report. But you start with something interesting, which was the GDP. You brought up a couple of points about the gross domestic product. And even though it's been negative for the first 2 quarters, tell us why, statistics may lie or there's something else underneath that.
Yeah, and let's step back for a sec, because you kind of glossed over, I think, an important point of does it matter if we're in a recession? Certainly it matters to people that are struggling. Certainly it matters to people who aren't struggling. But hearing people talk about if we're in a recession over the last week, it's almost been as if there's this dogmatic idea that we need to know yes or no. If we're in a recession, the government's going to call up the National Guard and all this legislation is going to be triggered and all this money is going to go. That nothing really happens. If we're in a recession, we're in a recession. If we're not in a recession, we're not. Obviously, again, it matters to people if they're struggling, but it's a term. And if somebody says we're in a recession, somebody says we're not, great. You can have your own opinion and nobody's going to argue. And the White House wants to make it a political thing and the media wants to make it a political thing. And I'm not going to get into politics. But long story short, if you disagree with if we're in a recession or not, great. The more important thing is the data, and the more important thing is what's really going on the ground and what people are seeing and feeling. And so you asked about GDP. So the common sense definition of recession over the past however long, 40, 50 years, has been 2 negative successive quarters of GDP. So GDP is kind of the total output of the economy, the total amount of money that's flowing through the economy. And if that goes down quarter after quarter, that means the economy is not doing well. If it goes down 2 quarters in a row, we've said that's a recession. Now, a couple of things to keep in mind. Certainly, if GDP is negative, if the economy is contracting and we're seeing contraction instead of growth, certainly that's not a good thing for the economy. Nobody likes that. But it's a little bit more nuanced than that. There are a couple of things that factor into GDP that we have to keep in mind. A big one is imports and exports. So when we export something, when we send something overseas, that helps our GDP. We're selling something and our GDP goes up. Conversely, when we buy something or when we import something from overseas, our GDP goes down. We're buying something, we're not contributing to our economy. And so a big trade imbalance is going to hurt GDP. Now, does that mean a big trade imbalance is bad for the economy? I would argue that it's not. I mean, I know a lot of people think the fact that we have a $500 billion trade imbalance with China is the worst thing in the world. I don't think it's that bad. I mean, the fact that we have such a large trade imbalance, the reason we have such a large trade imbalance is because China makes a lot of really cheap crap that would be a lot more expensive if we made it ourselves. And if you look at the standard of living in this country over the last 30, 40 years, a lot of that is due to the fact that we can buy all this really cheap stuff from China because they're exploiting their people. That's not good, but it's been good for us. We're getting cheap TVs and cheap computers and cheap cars and cheap all this other stuff. So large trade imbalances in and of themselves aren't necessarily a bad thing. But over the last couple of quarters, we've seen the largest trade imbalances in the history of this country. And that's driven GDP down. And so you could argue that GDP hasn't been, or the economy hasn't been that bad, but the number looks worse because we've had a large trade imbalance. The other thing to look at is with COVID, businesses were struggling to buy inventory. Businesses were struggling to import stuff, raw materials and widgets and end products. And so things started to open up last year, the end of last year. And in Q4 of last year, businesses went on the largest spending spree in the history of this country. Our GDP in Q4 last year was almost 7%, which was fantastic. The reason for that was because businesses finally saw the opportunity to start buying all this inventory that had been locked down. And the reason they wanted to do that was because they didn't want to take the chance of another COVID happening and their warehouses being empty. So they stocked up, they filled their warehouses to the brim. And when they did that, they were still selling a lot of stuff in Q1 of this year and Q2 of this year, but they had so much extra stuff that they didn't have to go out and buy more stuff. They didn't have to go out and buy more inventory because they bought so much in Q4. And when businesses stop buying inventory, that hurts GDP. And again, it made the GDP number look a lot worse than it otherwise probably would have, because it wasn't that they weren't buying stuff because they weren't selling stuff. They were still selling stuff. They just didn't need to buy because they bought so much in Q4. So if you were able to take kind of that 7% GDP number in Q4 and kind of spread it out over Q1 and Q2, the way they actually sold those products, we may not have seen negative GDP in Q1 and Q2. But again, all that is irrelevant. If you want to think negative GDP in Q1 and Q2 is a recession, great, use the word recession. If you want to be more nuanced about it, let's keep talking about what does the data really show other than GDP about where the economy is and where things are headed.
And one of those other factors, I believe, is unemployment, which I think is probably the best argument that I've heard that, hey, everything's fine. I remember somebody making a post. Maybe it was our good friend Kathy Fetke made a great post, and it was like, hey, if we're in a recession, I mean, we've got unemployment is robust, whatever the number is, 3.5, 3.6, whatever it is. But talk a little about unemployment and where we are in unemployment and how that factors into your analysis.
Yeah, and you just summarized it really well there. And typically, I like to think if I'm agreeing with Kathy, then I'm probably on the right track. She's brilliant. But unemployment, is other than GDP, and in some cases even more so than GDP. Unemployment is one of the best indicators of what's going on in the economy. When unemployment's high, people are suffering. People don't have jobs. Obviously, there are things like wages and hours. If wages are going down or hours are going down, we can look at that as part of unemployment. But if unemployment is low, then in theory, people are working, businesses are doing well. One thing to keep in mind when we talk about recession, a lot of times we view a recession through the lens of people. If people are suffering, then obviously it's not good and the economy is bad. But in reality, the way from a data standpoint, the way most recessions play out are how much businesses are suffering or not suffering. So if you really want to know what's going on in the economy, the businesses are the leading indicator. The people are the trailing indicator. So if businesses are suffering today, even if unemployment is low, that means over the next 6 months, unemployment's going to go up, wages are going to go down, people are going to get their hours cut. So if you really want to know what's likely to happen in the next 6 months, look at businesses first, and then look at the consumer data second. So unemployment right now, 3.6%, I think was the June reading, which is historically low. I mean, I think it matches what it was pre-COVID. And so there's no argument that people are employed. Certainly, we're seeing strong wage growth. Now, obviously, it's nominal wage growth, and the word nominal means like the absolute value, the number. We're seeing wage growth, I think 1.3% last month, which is great. Obviously, it's not good when inflation's higher than that. So, and we'll talk about that separately. Yeah. But if you kind of look at wage growth in a what's the word I'm looking for? In a
vacuum.
In a vacuum, thank you. If you look at unemployment numbers in a vacuum, if you look at the number of hours people are working in a vacuum, all these numbers are absolutely fantastic. Now, we do have this weird thing, and nobody can quite figure it out, is that this thing called the labor participation rate, LPR, is lower than it's been in many decades, meaning fewer people are working, but we also have low unemployment. So that means that there are all these people that aren't working but aren't complaining about it. And nobody really knows why that is. I mean, I think it's a combination of a lot of things. One, I think COVID encouraged a lot of people who were on the cusp of retirement to retire early, and they never came back into the workforce. So we had more retirements than we expected. Certainly, there's the gig economy, people driving for DoorDash and people doing Uber and all those things. And then certainly
crypto.
Yeah. Well, and that's the other big thing, not just crypto, but in general, a lot of people made a lot of money during COVID, thanks to all these asset bubbles. Right. So a lot of them just said, I'm not going to work until I need to work. And I don't think they're going to be out of the labor force forever, but it could be another few months or a couple of years. So in general, unemployment, if you look at that as it's kind of in its own bucket, unemployment is really strong, and it would be an absolute anomaly to be in a recession and see unemployment and the other numbers relating to unemployment where they are today.
And do you think, let's tie it back to sort of multifamily stuff. Do you think unemployment is, where do you see that ranked? To me, that seems like it's it's the most important thing for multifamily investors, because obviously, it's all based on rents and cash flow and cap rates and all that stuff. Can you tie a little bit to multifamily and how important is that unemployment number for where multifamily is going to be going in the next, foreseeable future?
Yeah, so I think that certainly unemployment is probably the largest driver of occupancy, and wage growth is certainly the largest driver of income. Well, population and wage growth are the largest drivers of rent growth. And I think we're going to continue to see increased or stable occupancy and increased rent growth as long as unemployment stays low. One of the things I'm concerned about, and I haven't really dug into the data on this, and I really want to, is as apartment owners or as landlords, a lot of us have this rule where we require our tenants to have at least 3 times monthly rent in income. So if rent is $1,000, we have to have at least $3,000 in gross income for that month. And so the question becomes, there's always been some runway. We haven't really been close to that 3x number for a lot of our tenants, at least not in the B and C class properties over the last several years. I can't speak for A class because I'm not in that space. But I have to imagine that we're starting to bump up against that 3x criteria. And so when rents get too high and wage growth isn't as high as rent inflation and inflation overall, we're going to start running into this issue where we may have tenants who they think they can qualify, maybe they even can qualify, but on paper, based on that 3x rent criteria, maybe don't qualify. And I think we're going to see smaller pools of renters over the next several years, which is not necessarily going to drive rents down. I don't believe rents are going down, but I think it's certainly going to slow the growth of rent over the next few years. And I think we're going to approach kind of that historic average of 2, 3, 4%, as opposed to where we are in a lot of markets right now at 5, 7, 10%.
Yeah, and I'm going to state the obvious, but obviously there's no such thing as sort of a multifamily real estate market anyway, right? It's all local, and there's we talk about demographics. There are people that are moving into places and places where people are moving out of places, and so it really is a localized thing. So you want to be doing all this analysis in each individual submarket. Next is inflation, which is obviously the hot button of today. Before we go to inflation, I always forget to remind people if you're getting some value to this, smash that like button on the YouTube show, because that always helps us out and gets us to great guests like yourself. But inflation's a big deal. Talk about where inflation fits into your analysis and whether we're in or heading into a recession.
Yeah, so inflation sucks. And I think we all agree that it's a big issue. But let's break inflation down a little bit. There are 2 sides to inflation. There's demand side inflation, there's supply side inflation. Demand side inflation is basically we've printed a ridiculous amount of money over the past, I could say 3 years, but it's actually 15 years. Since 2008, we've printed a ridiculous amount of money. There's all this money flowing through the system, which means everybody is a little bit richer. That's not true. Half the people are a lot richer and half the people aren't. But a lot of people are a lot more wealthy than they were, and they have all this disposable income, and now they start spending this income. And businesses have to hire more people to fulfill all these product requests, and restaurants have to hire more waitresses, and Amazon has to build more warehouses, and all of these things. And all these things cost money, and businesses pass that cost on consumers, and that's inflation. So that's demand side inflation. The fact that we're printing all this money, that people are spending all this money, and it drives costs up. Then there's the other side. There's the supply side inflation. Supply side inflation, I know there's arguments over how much of the inflation is driven by supplier demand, but certainly we're not seeing the flow of materials and products around the world the way we were 5 years ago. We talk about oil prices, lots of issues with oil. And again, I'm not going to get political, but I will say in defense of the administration and the oil companies, when you shut down oil wells, it's not flipping a light bulb. Back in 2020, oil companies had, literally there were tankers, thousands of tankers sitting off the coast of California with oil that had nothing to do with it. Oil prices plummeted to near zero. And so these oil companies turned off their wells. And when you turn back on your wells, that can take months or years. And so building up the supply of oil again is certainly contributing to high oil prices. Now, there's other things. There's oil companies taking huge profits. There's certainly government regulation that plays in there, no doubt about it. Then there's the fact that oil companies they love the fact that they're making so much money that they're just not releasing a ton of supply. So that's oil, but we're seeing the same thing in every industry. And so there's still supply side constraints that may last for many more months, many more years, which is making it difficult to get stuff. It's still hard for me to get windows. It's still hard for me to get garage doors for the houses that we're renovating. And so there's supply side inflation as well. And between the two, obviously that's bad for the economy. But I will say this, that the fact that we're still seeing high inflation, and my guess is July numbers are going to be a good bit lower than June numbers, we'll see. But the fact that we're seeing high inflationary numbers, that's another indicator that we're not yet in a recession. Typically, low inflation is the indication of a recession. The way recessions work is there's high inflation. The Federal Reserve says we don't like high inflation, so we raise interest rates. That encourages people to start saving, to stop spending. Money stops flowing through the economy. People stop buying stuff and prices plummet. And then we're in a recession. And so I think the fact that we still have high interest rates, it means one of two things. One, we're on the cusp of a recession. We're going to keep raising interest rates until things collapse. Or, and we can talk about this separately, we're on the cusp of something called stagflation, where we hit a recession and we still have high inflation. And that's a whole other beast that let's all hope doesn't happen. I know people throw that word around. We're not seeing stagflation right now. I don't like to throw that word around because that's a serious issue. And so what I believe is that what we're seeing right now is we're over the peak of the market. The Federal Reserve is going to keep raising interest rates. At some point, inflation is going to plummet. We're going to see inflation down to 4%, maybe even 3%. And that's when the recession is going to hit, because the reason that we're going to see inflation numbers drop is because nobody's buying anything anymore. So I personally think the high inflation right now is an indicator that we're not quite yet in a recession, but we're getting close.
Yeah, and if you go back and look at history and you look at the inflationary periods, like everybody talks about the 1970s. I actually have been paying a lot of attention to the 1940s because a little bit more. I think it's a lot more similar to where we are today, with really low, zero interest rates, and ultimately the Fed wasn't able to raise rates along with inflation rates, but it never goes up in a straight line. It doesn't go from like 0 to 3 to 9 to 15 to 20. It goes to 9, then it goes back down to 6, and it goes back to 3, and then it goes to 12. And it's just a zigzagging throughout the decade, and so it'll be interesting to see that.
Here's something to think about. Everybody says, people that argue for demand side inflation, people that say we've printed so much money, it was inevitable that we have inflation. At some point, yes, it's inevitable, but it doesn't mean that the printing in 2020 has led to the inflation we're seeing here. And this is my argument for why I think there's still a lot of supply side inflation, and there's still a lot of supply constraints. Look at 2008. Between 2008 and 2013, we printed $4 trillion, which less than we printed after 2020, but order of magnitude, it's the same. I mean, ridiculous amount of money we printed after 2008. And what was inflation after 2008? It's been at 2% for the last decade. If anything, the Fed's been complaining that inflation was too low, and that was bad for the economy. And so you could argue that, all this printing of the money, all this money printing is causing inflation. And certainly there's an impact there. But don't assume that printing money has to lead to inflation, because we saw after 2008 that that's not necessarily the case.
Well, I'll give you my 2 cents on that, and I want to move on. But a little tic-tac, if you really want to get technical, the Fed actually doesn't print money. That's the issue, right? The Fed prints
the Treasury
reserve.
Prints money.
Yeah, the Fed just prints Federal Reserve notes reserves, and they give those to the commercial banks. So unless the banks actually lend out, that money doesn't actually get into the economy. The difference these days is that we did have the Treasury issuing trillions of dollars for COVID and the CARES Act, and that money definitely, that was helicopter money that definitely got directly into people's bank account. But I don't want to get too technical. Talk a little bit about yield curve and the other stuff, but I really want to get into your final one, and then I want to open it up to questions, because I want to make sure we're addressing, these are all fascinating stuff for me and you, but I want to make sure that the community is getting value here from what's meeting them. So make sure you're dropping questions. I see a bunch of them already in the chat, but drop a question here. Don't spend too many. We can spend the whole weekend on the next one, but the next one was the yield curve, bond rates, and mortgage rates. Obviously, we're interested in mortgage rates, but talk about how that falls into your analysis.
Yeah, so we have all these esoteric type numbers. We have treasury bonds, and we have mortgage rates, and we have risk-free premiums, and we have yield curves, and all these other things that you hear. Long story short, if you look at the trends for these things, what we're seeing now is we're seeing a lot of stuff that tends to happen leading up to a recession. We're not necessarily seeing stuff that happens during a recession. And the big example I use is this thing called the yield curve. And that's basically this plotting of a graph of these treasury bond yields that the government puts out. And it doesn't really matter what it means, except that we talk about this thing called a yield curve inversion. That's where short-term treasury bonds, like 2-year treasury bonds, are generating more money for investors than 10 or 20 or 30-year treasury bonds, which is normally not the case. And the reason that happens, the reason we see that variation in pricing is when investors get really worried, they don't know what's going on. It doesn't happen when we're in the midst of a horrible recession. Like in 2008, we didn't see a yield curve inversion because everybody knew what was going on. There was no surprises. People could plan because they knew things are bad. People could basically move their money where they needed to go because they knew what was likely to happen over the next couple of years. We see this yield curve inversion when investors are confused and when investors are worried that they don't know what's going on. And this is why we typically see a yield curve inversion about 6 to 12 months before a recession. Because that's when investors are really confused about what's going on. They see that things are breaking, but they haven't really broken yet. So they don't know, should I be moving money out of stocks and into treasury bonds? Should I be moving money out of crypto into real estate? They just don't know what to do. And so that tells me that it's a good way to keep your finger on the pulse of what investors are thinking. The fact that we're in the midst of a really bad yield curve inversion literally today tells me that investors are really confused about where the market is right now. Investors haven't decided that we're in a recession or we're not in a recession. They've decided that they have no idea where the hell we are. And so that tells me, again, that investors are ready to kind of move in any direction. And as soon as things start to kind of show cracks, as soon as, again, unemployment goes up or the stock market starts to go down again or mortgage rates spike again, investors are going to flee and things could get really bad. But right now, investors don't think that we're necessarily in a recession. They think we're in some transition period and they're not really sure what's going on.
Talk about more. I think there's a question in there somewhere about the mortgage rate. So obviously mortgage rates have skyrocketed over the past, 6 to 12 months. First of all, just in your own practice, are you seeing that? How are you seeing that affect the market in general? Are you seeing it softening a little bit? Is it becoming a little bit more of a buyer's market versus seller's market? Give us just from since you're in the trenches there, what you're seeing is the consequences of this increase in the interest rates, and then talk a little bit more generally how it fits into your analysis of the current economic picture.
Yeah, certainly what I'm seeing is that interest rates are hurting the multifamily market, softening the market. Not necessarily values dropping, but a whole lot less demand, a whole lot less competition for deals. And the big reason for that is obviously, again, mortgage rates are going up, which means the cost of capital is going up. It costs more money to borrow. And so you don't have as much money left over for your investors and for yourself at the end of the day. So you can't pay as much for a property. And so what we're seeing is a few things. So two typical types of debt that multifamily or commercial real estate investors get. There's what's called agency debt. And this is getting loans from like the Fannie Mae, the Freddie Mac, the big quasi-governmental institutions. And then there's the bridge debt. That's basically getting loans from banks. That's shorter term loans, typically interest only. And so what I'm seeing right now is essentially nobody's going the agency route. Nobody can get bridge debt. And the reason for that is because with interest rates high, there's this number called the DSCR, debt service coverage ratio. Basically, your property needs to be making enough money to be paying your entire mortgage, plus have about 20% left over at the end of every month. And so what banks are seeing is if they give their typical 75% loan to value or loan to cost loans, your mortgage is too high. You don't have enough, you're not generating enough cash from the property to pay your mortgage plus have this 20% left over. So if you're going to go this route, basically you're getting 55, 60% at best loan to value or loan to cost loan. So nobody's going that route. So basically Fannie Mae is complaining that they have all this money and they can't deploy it. So everybody's going the bridge route. And so bridge loans are great. The reason why people can do bridge loans instead of agency debt is because a lot of times it's interest only. And so you're not paying principal every month. So your loan costs are down. But on the downside with bridge debt, it's typically 2, 3, 4, 5-year debt. And you typically have to pay to renew it in successive years. And so a lot of people are going this bridge debt route, but they're scared because if we're still in a recession, or if we hit a recession in 2 or 3 years and they have to refinance and rates are higher, or lending is tighter and they can't refinance. So there are a lot of people who are scared right now of financing. They don't know what to do. They don't want to pay the high rates, but even if they do pay the high rates, they don't want to do what it requires to pay the high rates, which is take a risk that they're going to have a loan that they're going to have to refinance in 2 or 3 or 4 years. So certainly that's become a big issue. We have a property that we were under contract to sell, and the buyer backed out at the last minute, basically said we couldn't get a loan. And we haven't seen that. It's been years since we've seen anything like that because it's been easy to get money. Here's the other interesting thing for anybody out there that's doing syndication and raising money. With interest rates now, and even bridge debt, we're seeing interest rates in the 7.5% range. If I have the choice between going out and getting a loan at 7 or 7.5%, or raising money with a preferred return of 6 or 7%, I'm going to generate more cash flow by raising equity, by paying my investors 6% than by paying the bank 7 or 8%. So one of the trends I have a feeling we're going to start seeing over the next several months is that investors are going to say, okay, I'm happy with a smaller loan and I'm just going to raise more equity. Now, on the back end, that hurts. It costs more money to pay an investor than to pay a bank when you sell the property. But in terms of cash flow every month, it costs less because, again, you're paying the investor 6% perhaps, and you're paying the bank 7 or 8%. So one of the things I'm starting to see and that we're doing, that I have a feeling a lot of people are going to be doing, is that we're going to see a lot smaller loan to value loans and a lot more equity raising. And so I think a lot of syndicators are going to need a lot more money. And so what happens when there's a lot of demand for money and the same amount of supply, potentially we could see what investors are demanding going up.
Yeah, and in fact, I know there's a large client that did that. They found a great deal, but it's 60% LTV, and they're going to have to raise a bunch of money. But it's just a great asset class. So,
yep.
If you want to hear like a little plug for the couple of episodes ago, we had Eric Stewart on about 3 episodes ago. We did a whole deep dive into the current status of mortgage. If you're interested in that, I would definitely recommend taking a look at that, because you echoed exactly what he was talking about. It's because I was under the impression that lenders, the agencies just didn't want to lend. They were getting a little scared, a little frothy. Let's not do it. We're going to reduce. That was like, hey, that's a clue that they're reducing their LTV. But Eric was like, just like you, they're willing, able, and ready to loan at 80% if you can find a property that actually has that debt coverage ratio that matches the 1.2 or 1.3, whatever the bank's requiring. So that was actually a relief, because I actually thought, hey, if the banks are already getting a little scary and they're not willing to lend on the current values, then maybe that's a clue. But it just turns out that the debt coverage. All right, my friend, we got a bunch of questions, but I want to go into the last one because it's probably one of the most important, the big one. So I wanted to spend some time. And then I promise you we'll get to these questions. Well, I don't want to commit Jay to staying longer, but what's the last one? The last one is
consumer sentiment.
Yeah.
And so this is the one that's less quantifiable, but probably the most important one on the list. So University of Michigan every month does this poll, and they've been doing it for a couple of decades now, where they basically poll people on how are you feeling about the economy? Are you spending money? Are you not spending money? I honestly, I'm making that up. I have no idea what the poll is, but I do know that they come out with a rating between 1 and 100 of consumer confidence. And in June of this year, that number was 50, I believe, 50 or 51, which was telling because the lowest it's ever been in the history of that polling, and again, it's been a couple decades, but I think it got down to 56 in the summer of 2008. So basically what that's saying is consumer confidence about the economy right now is lowest that it's been in at least 20 years, and it's a good bit lower than it was even in 2008 in the worst part of the Great Recession. And so again, is this reflective of what people are really experiencing? Are people like struggling? Is this reflective of what people are expecting to happen? I don't know. But what it means is and this is why this number is important, is that number, that consumer confidence, consumer sentiment number, it may not influence what's happening today, but it's going to influence how those individuals act. It's going to influence how they spend money or save money. It's going to influence whether they work an extra job. It's going to influence whether they take a lower paying job. It's going to influence all their behaviors and decisions financially over the next several months and years. And so if people think that the economy is going into the toilet, if people think that we're either in a recession or we're headed towards a recession, people are going to start acting in a way that they act when we're in a recession. And the way people act in a recession is in a way that propagates the recession. They stop spending money. They start looking for deals. They stop traveling. They stop buying luxury goods. They are willing to take lower paying jobs. They quit their jobs and do home care for their little ones because daycare is so expensive, things like that. And so if people think we're heading towards a recession, they're going to start acting in a way that's going to make the recession more likely to happen. And it's going to make the recession more likely to be steeper than if people believed that everything were great. And so the fact that this consumer sentiment number is low, again, doesn't necessarily mean we're in a recession, but it's a good indicator that we're going to see a snowball effect where ideas drive actions, and actions drive consequences.
Yep. And I think that's a legal term you use, right? That we're in the toilet. That's a very legal definition of where consumer spending is. Okay, so let's just tie it all in a bow. So at the end of the day, give us the punchline. Now that you've taken in all those factors, the GDP, the inflation, the unemployment, the curves, the sentiment.
Yeah.
What is the J. Scott prognosis here of where we are, where we're going, and what are your thoughts there then?
So if you like the definition of negative GDP 2 successive quarters, then we're in a recession. Great. If you want to be more nuanced about it, I think it's hard to argue that we are currently in a recession, but I think it's really easy to argue that we're on the cusp of one, and I think it's going to be difficult to avoid one. So again, I don't think it matters. Nobody's going to, the government's not going to release the hounds when the word recession is officially declared. So it doesn't matter if you think we are or we aren't. But I think the reality is that whether we are or we aren't, we're at least on the cusp of one. And I think that over the next several months, things are only going to get worse, not better. Awesome.
All right. Give you a little bit of a break there. Let's get to some of the questions. Bethany, just to make sure we get to as many as we can, why don't you just, or maybe we'll alternate here, but why don't you just read that? Usually we bring them on and we share a screen outside, but it'd probably be quicker if we just read the question. Why don't we just alternate, Bethany, as we go down this list?
Yeah, I can read some of them, and you've covered actually a fair amount, Jay. So I think you've given the people what they want for the most part. There's a really good segue to actually one of the later questions, which is not so much consumer sentiment, but how powerful is investor sentiment in determining the progression of an uncertain economy? And that's Donato Callahan asked, and he said, can investors effectively temper their reactions and sort of steer the economy in a more desirable direction?
Yeah. So with respect to the CEO, I think Christopher mentioned the CEO confidence index is at 40, which is very low. It goes back to what I was saying earlier, which is what people are experiencing is obviously really important. But the leading indicator for what's going to happen in our economy is what business owners think is going on. Because ultimately what happens with businesses is going to happen first before it affects consumers. And so the fact that business owners, CEOs are kind of sanguine right now about what's going on, and they think that we're basically heading into a downturn, that means they're going to stop spending money, and they're going to stop hiring, and they're going to start laying off, and they're going to start cutting hours, and they're going to stop buying extra inventory, and they're going to do all these things that ultimately are going to hurt the economy. And so, yes, certainly one of the first things we like to look at, and when I say we, I shouldn't say we because I'm not an economist, but one of the first things economists like to look at is business sentiment and business spending and discretionary business spending. And what we're seeing that that's all pretty bad right now. And so very likely, again, even if we're not in a recession at this moment, the fact that businesses are going to start acting like we're in a recession means we're going to get there pretty quickly.
Yeah, and you know what? There's a question that I want to ask, but it also is a question I had for you that sort of ties in nicely. So I'm going to ask this because Anthony was asking, how much does China come into play with the economy? And I'm going to make a comment and then answer the China question, but maybe it's all in one. But somebody pointed out, I can't remember what podcast I was listening to brought this observation up. But generally, when economies go into recession, they don't all go into recession at once. Like when the U.S. goes into recession, China's doing okay, and whatever all the other major Russia's doing okay, whatever. And then if China slows down, we're doing okay. So that helps a little bit in terms of in compensation. But I think it might be the first time it's ever happened. But because of COVID and the sort of coordinated lockdowns, we're kind of all, the argument goes that we're all now sort of on the same schedule. And so if the US is going, Europe's going, China, everybody's going to be going into recession at the same time. And we're not going to have that ability to bail each other out as we do that. So it ties a little bit into the whole China thing, but can you comment on both of those? Have you heard that argument? Any thoughts on that? If that's if we do end up going into recession, it'll be a little bit more severe because we're not going to get bailed out because Europe's just going to be in just as bad or worse shape than we are?
Yeah, so certainly outside of my area of expertise, I don't want to pretend I know things that I don't. But anybody out there, one person I would suggest everybody read is Ray Dalio. So Ray Dalio he's a hedge fund manager, billionaire, but he's also like a brilliant historian when it comes to economics and political trends. Basically, he's gone back thousands of years and basically said you can track political and financial and economic trends literally because everything that's happened today has happened hundreds of times throughout the world, throughout history. And so he does a really good job of equating what's going on today to previous times. And certainly one of the things he says is that exactly what you just said, Mauricio, which is at this point, it's looking like this is going to be a global downturn as opposed to a local one. 2008, as bad as it was in the US, it did impact other parts of the world, but there were no foundational issues in other parts of the world. It was basically when the richest person stops spending, obviously it's going to hurt all the places they're spending money. But this time it really is, there's a foundational crisis around the world, certainly not being helped by the fact that we have the Russia-Ukraine situation and all the political infighting there. And I think one of the things that I'm really concerned about, and again, Ray Dalio has written a lot about this, is that we're going to have the Russia-Ukraine war at a time when there's not only political instability around the world, but there's also economic instability around the world, which could ultimately lead to a currency crisis. And right now, the reason why the U.S. is the preeminent superpower in the world, you can argue it's our government, you can argue it's our military, but at the end of the day, it really boils down to the fact that we have the world's reserve currency. Means we get to make all the rules and we get to break the rules and we get to do whatever we want. And if and when, not if, but when the day comes, and whether it's a year from now or 10 years from now or 100 years from now, when the day comes that we're no longer the world's reserve currency, which is what China would love and Russia would love and a lot of other countries would love, we basically lose a lot of the leverage that we have. At that point, we can't just indiscriminately print dollars because dollars suddenly aren't worth as much as they were. We can't bail ourselves out of economic crises. So basically, the most concerning potential issue is if we end up in a currency war where Russia, China, and some other countries get together and figure out a way to kind of make the dollar no longer the world's reserve currency. And right now, there's really no other competitors that seem like they're really on even the same playing field, but that can change quickly.
Yeah, I could go into that one for another.
Yeah, that's a whole, again, a little bit outside my area of expertise, but yeah, that could be another hour discussion.
I don't know if
you answered a question there. So
good. By the way, just Bethany, you take the next one, but I wanted to get in here. How you talked about the mortgage rates and how it's affecting multifamily right now. How high, do you have a crystal ball? How high do you think these rates will go?
Well, it's funny. I made a prediction a month and a half, 2 months ago that with I think it was the June Fed rate increase, we saw rates go to low sixes. And I basically said, no matter how many more times the Fed increases rates, we're not going to see anything over like 6.5. We still haven't seen anything over 6.5. And actually, we're down around, I think 5.3 was the 30-year fixed rate today. And so people are kind of confused. So if the Fed just raised rates 3/4 of a point, why are mortgage rates going down? And again, it goes back to this investor uncertainty. When investors are scared and don't know what's going on, they demand different types of returns. I'm not going to go into mortgage-backed securities and how but basically, when investors don't know what's going on, that does weird things to treasury rates and mortgage rates. And then when investors do have an idea of where things are and they're less comfortable that like there's an imminent collapse coming, everything kind of settles down. And so what we're seeing was for a long time, the Fed raised rates and they might have raised rates 3/4 of a point, and then mortgage rates went up 2 points. And so that was just kind of a weird anomaly of just investors acting all weird. But now we're kind of settling down. And so even though the Fed has raised rates another 3/4 of a point, we're no longer seeing that big spread that we saw from the last rate hike. And we're actually seeing that spread come down and rates come down. So I think we may see, depending on whether inflation goes away in the next month or two, or whether the Fed has to hike rates a couple more times, I think we could get back up into the low sixes. But anybody that's talking, and I hear people talking about 10% and 12%. If mortgage rates get above 7%, I'd be tremendously surprised. I don't think we're going higher than where we've been.
Yeah, and don't forget that again, these are all super. I mean, everybody thinks that they want an easy answer and one answer, and there's probably 74 things going on at one time. But don't forget that the Fed is not only pulling the lever of interest rates, but they're also buying and selling, and they've got that capacity of the mortgage-backed securities. At the end of the day, the mortgage rates are based on supply and demand, and so if the Fed is selling a bunch of their mortgage-backed securities, that means that the price of those mortgage-backed securities is going to go down, which means the interest rate is going to go up, and vice versa. If they start printing reserves and buying more mortgage-backed securities, that's going to do the opposite. So it's not just the Fed funds rate. In fact, I've heard a lot of people arguing that has very little to do with it. It's more about sort of, like you said, investor sentiment and where they think things are going. So,
and here's the thing: I think a better question than where are mortgage rates going? Where are cap rates going? Because if you look at the definition of value in commercial real estate, it's NOI divided by cap rate. There's no mortgage rate in that equation. And so the big questions that we should care about as commercial investors is where are incomes going, where's NOI going, and where are cap rates going? And so that to me is the more interesting question. Yeah.
And where are cap rates going, Jay?
So nobody knows. But I will say that, so there are a couple of big things that impact cap rates. Number one is this idea of what's called the risk-free rate. So basically, an investor has a choice. They can take their money and they can stick it in U.S. Treasury bonds at whatever the rates are and basically have zero risk whatsoever. I mean, the government would have to go insolvent before they lost that money. Or they can go into another investment, the stock market or real estate or crypto, and they're taking some level of risk. And so they're going to demand some return above that Treasury rate in order to take that risk. And so if you go back a year, the 2-year Treasury was down at like 0.2%, down near about 0%. And in my main market, Houston, cap rates were around 3.5%. So you could basically say that investors were demanding about 3% higher returns to take the risk of investing in multifamily in Houston. That was kind of the delta between the risk-free rate and cap rates. So hopefully everybody followed that. So as Treasury rates go up, assuming that risk-free rate stays the same, that delta stays the same, cap rates should go up the same amount. So if risk-free rates, if Treasury yields go up 1%, and investors say we still need a 3% increase above Treasury yields, then you would expect cap rates to go up 1%. Well, at this point, Treasury rates are up. I think the 2-year is at almost 3%. So Treasury rates are almost 3%. So in theory, if everything were completely efficient, we would see cap rates in Houston at about 6.5%. We're seeing them actually at about 4.5%. So why is that? And the reason is that, yes, the risk-free rate has gone up, but a lot of investors are now coming into real estate. They're saying, I'm willing to take less of a risk. I don't need that 3% more than the risk-free rate to invest in real estate. I'm happy at 1.5 more to invest in real estate because I love real estate right now and I don't consider it as risky as I did a year ago. So why don't people consider multifamily in my case, or in this case, as risky? Well, a couple of reasons. Number one, the stock market hasn't been performing really well. People don't have control over the stock market. They feel like they have some control over real estate. So a lot of people are moving money out of the stock market into real estate. Number two, inflation is still super high. What's the absolute best inflation hedge on the planet for what's the best inflation hedge on the planet? Real estate, and especially long-term fixed rate debt, which you can get from a lot of real estate investments. So people are moving money into real estate because of inflation. Number three, people like multifamily because we have this idea that there's this lower loss to lease. And loss to lease means basically what you're renting your units for compared to what the market rent is. If I have, let's say, an Amazon warehouse, and I'm renting it to Amazon and I'm charging them X dollars per year. And now inflation is, and we have a 10-year lease and inflation now goes through the roof. Well, Amazon's still paying whatever they negotiated into that contract. We can't raise the rates every year to keep up with inflation. So if I did a new contract with Amazon, it would probably be a lot higher, but because they're locked in, it's a lot lower. The nice thing about multifamily is that we get to change the rents every year. So as inflation goes up, we get to change the rents and increase the rents every year. So we have this lower loss to lease. And so that's one of the reasons why not only is real estate doing well, but multifamily is doing well. And these asset classes where you get to raise the rents in real time. So short-term rentals, which I have an issue with short-term rentals, but from this perspective, short-term rentals are good. RV parks, shorter-term mobile homes, those sorts of things are going to tend to do better in this high inflation environment. And people are going to want to put their money there because they know that their income is going to keep up with inflation because we can raise the rents every month or 6 months or a year. And so that's the reason why cap rates aren't going up as fast as the federal funds rate, the treasury yield rates. And I think we're going to continue to see that. I think we're going to see cap rates go up again. We've seen about a point of expansion. I think we may see a little bit more. But I also think that in the next 6, 12, 18 months, the Fed's likely to reverse course and lower interest rates and everything's going to get cheaper. And then we're going to see everything back to where it was 6 months ago.
Yeah, and it's interesting because that's why commercial. Somebody's asked about whether this is commercial or not. That's why commercial is so much different than single family and stuff because commercial is all based on rents, and so you can argue is this overpriced, whatever. But somebody's going to have to argue that rents are somehow going to go down or something. And in an inflationary period, rents nominally anyway go up. It's not that in real terms it might actually be going down, but in nominal terms it's going up. And as we all know, the value of that property is based on a multiple of that rent and rent growth. So
here's what I think everybody should do. Go to Google and type in, type in Fred, just the word Fred.
Right.
And the first thing that's going to come up is fred.stlouisfed.org. And basically, this is the best place to get your economic data. This is all the Federal Reserve data. And then do a search when you get to that page for market rents. And you're going to see, not even market rents, just rents. You're going to find a chart that is basically historic rents over time and what they've done. And that chart is very eye-opening for a lot of people. Basically, that chart only goes in one direction. Over the 70 years that chart shows market rents, and this is nationwide, obviously, right. Real estate's location dependent. Anything can happen in your city or your town. But across the US over the last 70 years, rents have never nominally gone down. 2008 to 2009, they flattened out for about a year and a half, never gone down. So if your concern is that we're going to get into a recession and rents are going to go down, I'm not saying it can't happen, but it will be the first time in history that it has.
That's great. And we'll figure out how to, maybe we'll post it on the Facebook community. By the way, if you're not a part of the Facebook community, I would highly recommend it. That's where it's a great community, by the way. Everybody jumps in there. And if you've got any questions on that or follow, Jay's a part of that community. So if you want to be able to hang out with Jay a little bit more, Facebook community is mauriciorauld.com/live. I'll put it in the chat. And while Bethany asks, Bethany, maybe just one more. I don't know if it's somebody who came earlier to give them credit for putting a question early in the chat, but maybe do one more.
Yeah, and you covered a lot of them, so that's really I think that's really great. We've got Michelle Kimbrough asking about what your opinion on the rewriting the definition of a recession, which she's sort of tongue in cheek, but you actually did touch on that a little bit about how people feel about having it be defined as 2 quarters of negative GDP. But do you want to touch on that?
Yeah. So one, let me start with, I think the White House did themselves a horrible disservice with their little political stunt of releasing that thing, because the only thing it achieved was some divisiveness. I don't think that was smart. That said, I mean, again, I wrote a book on this in 2018, and I made a point in the book that recessions are defined by NBER. They are the official declaration of recessions. And if you go to, like, again, if you're looking on the Fred website at any economic data, on all the graphs are these gray vertical bars that indicate recessions. And what you'll see is that those recessions don't line up nicely with when we've had negative quarters of GDP. That's NBER's definition of recessions over the last 100 years. And here's another thing I'll throw out there. I assume everybody here agrees back in 2001, we had a recession. Nobody disagrees we had a recession in 2001, right? Anybody? Mm-hmm. I'll take that as a no. We didn't have 2 negative quarters of GDP in 2001. Q1 was negative, Q3 was negative, but Q2 and Q4 were positive, and 2000 was positive and 2002 was positive. So we broke that quote unquote rule in 2001. Likewise, in 2008, most people agree, if you've looked at the data, that in 2008, the recession started in December 2007, actually. That's kind of the date we use. We didn't see 2 quarters of negative GDP until Q3 and Q4 of 2008. But NBER decided that December 2007 was when we saw enough bad stuff happening that's when they defined the recession. And so that was what officially got recorded. So again, it doesn't, if you want to think 2 quarters of negative GDP, I have no issue with that. If you want to think we're in a recession now, that's great. But just keep in mind that the data right now doesn't support what is typically a recession. Again, it's just a word, think whatever you want. But the data doesn't really support that. So in terms of rewriting the definition, I don't believe it's been rewritten. I think the White House made a horrible mistake to even suggest any of that. I mean, we could have just kept going and nobody would have even noticed. We can, if you want to use the term recession, I don't disagree.
Well, buddy, thank you so much for taking a whole hour of your time. I really, really appreciate it. Definitely follow, that 5-page Magnus Carta, whatever it's called, that was on his Facebook, but he's on Facebook, LinkedIn. Let the folks know where else they can get a hold of you or how to reach you, and tell them how they can find you.
Yeah. So if you want to invest with us, if you want to follow me, if you want to get on my newsletter, if you want to follow me on social media, go to www.connectwithjscott, just the letter J, Scott.com, connectwithjscott.com. And if you follow me on Facebook, I do those posts. I try and do once or twice a week, various economic topics or other topics, just because I like to write. But if you go to connectwithjscott.com, that'll kind of link you out to everything.
I love it, man. Well, again, thanks so much. I really appreciate you helping us today. And he's in the community. So if you got any follow-up, we didn't get your question, I apologize. If you think of a question later, just please post it on the community. I'll assure you, Jay will jump in there and answer it. All right, guys. I appreciate you, Jay. Thanks again. And we'll see you soon, buddy.
Thanks, everybody. Thanks, Mauricio. Thanks, Bethany.
Thank you.
Thank you.